Gentlemen, good day and welcome to the Q2 FY23 earnings conference call of Agro Foods, hosted by Anand Rathi Share and Stock Brokers. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ajay Thakur from Anand Rathi Share and Stock Brokers. Thank you, and over to you, sir.
Thanks, Steven. Good afternoon, everyone. On behalf of Anand Rathi, I welcome you all to the Q2 FY23 results conference call of Agro Foods Limited. From the management side, we have Mr. Sachin Gopal, Managing Director, and Mr. KPN Srinivas, CFO of the company. We shall start with opening remarks from the management and followed by the Q&A session. Now I will request Mr. Sachin Gopal for his opening remarks. Over to you, sir.
Thank you. Thank you, Ajay. Thank you, Stephen. Yeah. So good afternoon, everybody. Thank you for taking the time out to join us in today's conference call. We'll try and walk you through the highlights of the results, and then we can take the Q&A that you said. So I request you just to go through the presentation, which is already uploaded on our website, and go to page 3 of the presentation, right? So company mission and vision to be the best performing, the most respected foods company in India, right? Page 4, key performance highlights for quarter 2, foods revenues of about 124 crores. So this represents a growth of about 13% versus the prior year, but it's really the first time ever for us to clock close to about an annualized sales rate of 500 crores, right? So that's a very, very good milestone as we see it. When we started this business, we had a food business of 10 to 15 crores, and over the last 15 years with a CAGR of 19 to 20%, it's a nice feeling to be able to get to close to a 500 crore annualized running rate on a quarterly basis. It's time, therefore, also we will share with you now that we've got close to the 500 crore mark is, what will be the building blocks for us in the next few years so that we can get to from 500 to 1,000 crores. But that is something that we'll take up in the analyst meet in the month of November. Our non-RTC businesses really drove the total foods with a 33% revenue growth. This includes ready-to-eat snacks, it includes spreads, it includes chocolates and breakfast cereals, right? And it's a fairly complex piece to be able to get this, this kind of a growth on a diverse portfolio, but because it's a large number of commodities, lots of packaging materials, multiple plants, but it came out well. And the ready-to-cook business, as we will see later, was actually continued to be lower than prior year. Certainly there is impact of COVID-19 as far as this is concerned, but we always like to be a little careful, so we'll see what else we can do to be able to bring that into a positive volume space soon. Our food gross margin really improved from the quarter 1 low. As we told you when we entered quarter 1, there were a lot of headwinds, but they were all receding. It was as I use the word, I think, a tidal wave, and we saw the wave receding, and you can see the impact of that, right, in quarter 2. We're not yet back to where we need to be. We still have a long way to go, but it's a significant increase, and we will continue to work on improving the margin further. And really, this is a result of softening of commodity prices. Some amount of it is already in the P&L in quarter 2. Some of it is still to come in quarter 3, right? Impact of whatever pricing actions we have taken and volume growth in the non-RTC business. The edible oils GM of about 16 crores, I think it's about 15.6 crores, was within the broad desired range of 70 crores plus minus, right? We will continue to balance volume with gross margin in a volatile business, but it's not that we are going to forsake gross margin for the sake of volume. We are not going to do that, right? We will balance both of them, and margin will remain an important consideration for us, given the role of the portfolio in our business, right? The quarter 2 media was marginally below prior year. We also needed to be able to manage the P&L appropriately. So this needs some correction going forward, and we'll see how to do it. We've always said that we want to be in a 7 to 8% A&P spend. Obviously, there are many periods of time where we haven't been there because of the pressure on coming from the oil portfolio. But as that recedes in the share, the materiality of the oil business in our business comes down, or we'll have a little greater wiggle room, if you will, to be able to make the right level of investments. As a consequence, our gross margin increased, but our quarter 2 SG&A was higher than prior year by about 3 crores. There is some amount here due to employee benefit costs, which you would have seen in the advertisement, but also the largest elements are really travel and secondary freight, right? Travel, because there's a lot more travel now. We are almost back to the pre-COVID levels, but not exactly, right? So we are, I think, currently our travel is clocking at probably about 2.45 crores a quarter. Pre-COVID was a little more in the 2.6, 2.7, right? So it's coming back, and this is an investment that we need to make, right? Because this is an investment that we need to be able to drive our business to make sure that we continue to get the growth rates that we want. But we see this as like in a sense a correction. In the first year of COVID, our travel costs came down, right, by about $1 million. Now in this year, they are going up. That correction will happen, and then meanwhile, obviously, our gross margin will continue to grow. And secondary trade, largely because a lot of the growth in this year has come because of ready-to-eat snacks, which are more freight intensive as compared to other categories. Again, some amount of this is all balancing over time. It will correct because as ready-to-cook starts to grow, ready-to-eat is currently benefiting from the opening of the economy. Those benefits will not sustain on an ongoing basis, right? So there's lots of movement up and down, and the travel and the secondary freight are only one part of that, right? Which will hopefully settle down during the year. And therefore, the profit before tax and the profit after tax were 4 and 3 crores respectively. So let's go to page 5. Really, the 5 categories that food categories that we focus on are ready to cook, ready to eat Western snacks. We don't include Indian snacks in this. Spreads, breakfast cereals, and chocolate confectionery. In total, that represents a total addressable market of about $8 billion, right? And so from our standpoint, that's large enough for us to get the growth that we want to, at least in the near term, right? And we continue to focus on these 5 categories. Let's go to page 6, ready to cook snacks. So the impact of the price increases that we've taken in popcorn and sweet corn particularly is very high, visible in the value versus volume. Value is moving into positive space. There is some impact in this mix also because, pasta, noodles, these are also very, very good in terms of revenue per ton. So the non-RTC popcorn business is led right now. The growth is being led by pasta, which shows steady progression. However, there is a volume gap versus prior year due to COVID-19 in the base. And this is more than we would have liked to see, right? It's minus 4%. So this is something that we need to address and which we are working on as management because could be an impact of COVID. I mean, certainly there is an impact of COVID, but we don't want to be complacent about it. So we'll be putting more field force energy and other things in the back half of the year on this, right? Because this is a big part of the business, and if this goes nicely, all pieces fall into place, right? Because it helps margin, top line growth, all of those. We had mentioned to you some time ago that we'll be introducing a pizza and pasta sauce. So the commercial production of this is underway. That is happening as we speak, and it's looking good. And development of plant meat continues. The work is underway on texture for the right sensorial experience, right? So we are working on this. We have all the necessary tools in the machinery. I think it's just a question of, if you will, the time which will be taken for the development. There's a lot of action in this place. There are a lot of players, but we feel we have a strong competitive advantage because almost all the players who have introduced are not getting consumer demand. Right, the category is still small. Even in the US, it's kind of flattered, but it's a very important category because going forward, the role of protein is only going to increase. We are seeing that in peanut butter. That will happen with plant meats also. The only thing is the winner in this category or in this subcategory, if you will, and depending on how it's marketed, is going to be the people who have the capability to create categories. Right? A company which doesn't have the capability to create categories cannot win in this. And in our reading, actually, we are the only ones who have the capability to create categories. Right? We have the ability to create categories. We've done it with ready-to-cook popcorn. We've done it with peanut butter. So we have that capability, particularly from a consumer contact perspective. So we'll just get it right during the course of the year, and we'll keep you posted. So whether we are able to complete the development in the current year and launch it in the current year, or what is the status, that we'll update you as the year goes by. All right. Then the next category, which is page 7, is ready-to-eat snacks. Strong growth continues. Obviously, this is benefiting. This is the mirror image of RTC, where this is benefiting. Plus, there is a lot of strengthening in the RT popcorn business. So, what is the consumer trend on this? It's difficult to call, but there is a very positive, strong momentum on ready-to-eat popcorn, and we are obviously, the biggest beneficiaries of it since we are, amongst the largest players. There's a clear improvement in margin driven by price increases, grammage reduction, and packaging footprint changes. All of this happened last year with all the pressure that we had, and it's benefiting us today. So overall, the margin on the category is improving. And sweet snacks are starting to gain momentum. So, sweet snacks, as we probably mentioned to you, but we haven't, I'll just clarify, where, actually there's savory snacks have no sugar, so sweet snacks will have more sugar. They will also have less packaging material per ton of FG, and they will have less freight per kilo or per ton as compared to savory snacks, right? So right now we have caramel bliss popcorn, which is a relatively small part of the portfolio. We've launched the Duo Crunchies, which is an extruded pan product, which is doing very well wherever we put it. And which is currently being supplied from one plant, but very soon, starting this month, we'll start getting supplied from two plants, one in Kothur and one in Unnao, and then subsequently also in more plants as the year progresses. Work is underway also on value-added RT, including protein. We've talked about this earlier, right? And going forward, we will drive increasing share of sweet and value-added snacks to drive margin improvement for sustainable growth. So, as we told you several times, the savory snacks or ready-to-eat snacks is a very important portfolio because that's the conveyor belt for the company. That's what enables us to open more stores, to get up to the kind of coverage that we have today of about 450 or 1,000 stores. But we need it to be profitable. It shouldn't be, that we are losing money and therefore hesitating to grow. That should not be. And this incorporation of the sweet part within the RTE snack portfolio is a very important, I would say, a strategic move for us because it will enable improvement in profitability as well. And then, we'll never be hesitant to say, oh, we need to ship this product 300 or 400 kilometers. It will ship because, the freight is not going to be a killer for us. That's very important for us, right? Okay, then next page, which is page 8, spreads and dips, you can see return to very strong growth. We have a volume growth of 30%, and we've certainly taken that share. So as we mentioned to you about a year ago, we thought we were losing share. We think whatever we had lost, we got it back and maybe a little more. And right now we are absolutely rocking. That is evident in the numbers. In fact, we are very close to capacity now, or at capacity. So some capacity increase work is underway, and that will show up in the next couple of months. Our strategy to protect our share has really paid off big time. Competition has been really forced to replace the stock in trade. They spend a lot of money, right? There are a lot of competitors there. There's HUL and multiple others. But, and they spend money, right? HUL, for example, has spent close to 80 crores on this, right? Which is probably more than what we spent on our plant plus our cumulative advertising, or at least equal to it, right? And, but, they're having to replace stock in trade because the stock is dated, it's not moving. And so impact of the ATFL strategy is very visible in terms of freshness of stock. So that is something which is excellent. And, you can go into the trade and have a look at it yourself, check the PKD dates of ours and competitors, and you will know the answer to the question. We've also introduced a new high protein variant, Peak. This was introduced now in Q2 and the rollout is underway, right? This is an important sub-brand for us because over time it will become our protein, it will become the lead as far as the protein play is concerned. Today it's a lead as far as peanut butter is concerned. Tomorrow it could be for protein bars, etc., right? And so this is being introduced now, and we will be rolling this out with the necessary modifications also in our field force architecture. So that includes having sales people calling on gyms, getting the right endorsement from the people who are going to the gyms, getting the trial done there, etc. It will be a long game, this whole protein piece, but it will ensure that we are in rock solid position on this part of the business. And we've also launched a Choco Peanut Spread, which was launched in Q2, to complete the nut-based chocolate spreads range. So in the nut-based chocolate, we have a hazelnut chocolate, hazelnut-based chocolate, almond-based chocolate, and peanut chocolate, right? So this completes the nut-based chocolate range. That is also progressing well, and I would say it will be in line, and is one of the sort of many saplings that we are planting as we go along, which at some point in time will get to the 20-30 crore mark, and then we'll be ready for advertising support in the years to come. And we had also told you that we'll be launching salsa, so commercial production of salsa is underway now, and you will see that also in the market soon in the next month or so, depending on the rollout. All right. Coming to the next category, which is breakfast cereals, which is page 9. We have steady growth driven by distribution. We are now, the category is nudging the 100,000 mark in terms of distribution. As per our records, we are at about 95,000 stores, and that's a good place. It took a little bit of a backseat during COVID because our market working was not at the level that we would have liked to be. That is natural. It was visible in our travel expenses as well, and we were trying to safeguard the entire organization. But post the opening of COVID, now driving very fast, and I think we would be amongst the now lead players in terms of total breakfast cereals distribution, right? So as you know, we don't buy audit, but our management assessment is that the number one player in breakfast cereals will be Kellogg. We think that distribution will be somewhere in the range of 400 to 450,000 stores, right? And if anybody has data at any point in time, please do share that with us. It will be useful for us. We think the next most widely distributed breakfast cereals will be Marico Saffola masala oats, probably in the region of about 250,000 stores. That's our judgment. This is our field visit. And then we feel the other companies, which is Quaker Oats, which is a large player, but mostly only in big packs. So that will be a deterrent in terms of, getting numeric distribution. Tata Soulful would have been less, but with Tata they have rolled out a lot. But I think also they are facing a lot of challenges in terms of, the offtake from the stores. So let's see, how they are able to sustain their whatever distribution. We think that will also be in about a 1 lakh stores mark. Maybe it's more, and maybe they'll give some information on their call, and then we can look at it and discount it for whatever is the incremental stock in the trade. And ours are about so we think 1 and 2 are Kellogg and Marico Saffola masala oats, and 3, 4, and 5 is somewhere going to be between us, Tata Soulful and Quaker, and we'll see what the outcome of that is. The other piece which is important to note is we are in a very strong position in cereal snacks, right? Likely we have the highest distribution of center-filled cereals. What our market working tells us is that we are no doubt the most widely distributed center-filled cereal snack, right? So in other words, Kellogg will have a wider distribution than us, but in center-filled snacks, we think we have a wider distribution than them. We feel that they have a bigger turnover than us, right? We think that center-filled cereals is about 3% of their turnover of about 1,300 crores. So that's about, give or take, 35-40 crores. But a lot of that throughput will come in their case from large stores. Whereas in the small packs, once they come to it, we have a distinct competitive advantage, right? So this is important because a lot of the future of cereal snacks is going to lie in center-filled cereals. Center-filled cereals is a clearly different consumer experience, right? And it also caters to a slightly older age group. So if you Google Crave and do Kellogg's UK, you'll find that they've actually said that young people, 16 to 24, are more. Crave is the Kellogg equivalent of the center-filled in the UK and the US. You'll find are prime users, and naturally because they say I don't want to buy Chocos, I'm grown up, I want something else. Or as you become older, you consume more cereal as a snack. So this is a great position for us to be in, and it's something that we will leverage, right? So this will be our key growth driver. The introduction, we've introduced a hazelnut center-filled pops. It's been very, very well accepted, so that's doing well. And one more variant is scheduled for Q3. We're not telling you what it is right now, but you will see it, and then in January call we'll tell you about it. We've also started commercial production of value-added oats, the masala oats. We told you that the regular oats, the plain oats, we'll put under staples because we don't think that they have a 30% gross margin potential. At best, it will be 15 to 20%. So it fits in well with premium staples. And we'll work on this. Obviously, masala oats is a small part of the business, right? So for the people who have masala oats and regular oats, our estimate is that masala oats is 25% of the business, right? This is again our estimate from whatever we get from our field and whatever information we get, say, from CSD, Canteen Stores Department. But we think it's a reasonable estimate, right? So we will be, as far as this part of the presentation is concerned, we are focused on that 25%, which is the masala oats, and we'll see what other value add we'll do in the future. So game plan really underway for development for a bigger and stronger position in the breakfast cereal. So if you go into any retail store and you look at Kellogg, it's like a wall. You look at breakfast cereal, it's a wall. It's a Kellogg wall, right? Now, there may be other players on a regional basis. For example, if you go in North India, you see a little more Bagris. If you go in maybe Bombay and Bangalore, you might see a little more Yoga Bar, etc., etc. But the wall is Kellogg, right? It's a Kellogg wall. There's nobody else really, who comes close to them. So our task is how to break that wall. right? And that is something, that we are working on, and that is why we said there's a lot of work from our side will be how do we execute our shelf presence in the category. So this is work underway. It will take us time, but that's the key. And with that, we'll have a much bigger presence in breakfast cereals in the category. And also finding and addressing an unmet consumer need. We still feel there are unmet consumer needs in extruded breakfast cereals, which is where our strength is, and we are working on those. But at this point, we can't share those details with you, but you'll see it when you see it in the market. Okay. In terms of chocolates, continuing strong growth in the business driven by distribution. Once again, this is nudging the 100,000 mark with about 95,000 stores category distribution, right? You can see there's an increase in price realization, which is visible in value versus volume growth, right? Consequent improvement in margin as well. First phase of capacity enhancement has been completed. So we had said we'll put up a second line, and which we've done. Henceforth, we will not talk so much about lines because we are releasing more confidential information. So going forward, we'll share this information with you on a consolidated basis. But what we do want to tell you is that work is currently underway for about 100 crore plus capacity for FY24. Right? This won't happen by March. It's also not required because April, May, June is summer month and the business does come down. But it'll happen. It'll happen by the time the new season and the next monsoon, etc., comes in, right? So we'll be looking at completing this, and this will complete in one shot, right? Meaning meaning phase between now and June of next year, and then we'll see. There's obviously in any category which you're building like this, there'll be a lot of ups and downs. Output will change depending on what size of you are producing on a day, what is the kind of packaging work that you are doing, etc., etc. But broadly, this is what we are looking at: 100 plus crore capacity. This is in line with our thinking that in the next 3 to 5 years, a very large part of our growth is going to come from chocolates. Chocolates and ready to cook, we believe, will be the two major increments that will come, helping us to take from about 500 to 1,000 crores, right? So I would say we had one advanced question from one of our investors, so this answers, I think, that question as well, right? All right, so coming now to staples, premium staples, which is basically premium oils and includes some amount of oats right now, but very small. It certainly reflects softness, because we have significantly higher consumer prices related to prior year. I've seen a lot of commentary from more than one company saying that, they are marking down inventory and therefore, they will take the loss on that to be able to protect volume. We are not going to do that. We will, whatever is their pricing, we will move in line, but our focus will be on protecting margin. Okay, because that is the role of the category for us to give us margin, right, on a sustainable basis. But execution of strategy is also underway to make premium staples more broad-based while providing procurement scale to foods. So rollout of oats has started, and additional staples items are under development. And I would say the rollout of that will also happen in due course in the coming quarters, and we'll talk to you about it. And with each one, we'll explain to you what is the role as far as procurement is concerned, right? And March staples largely reflects the exit from Crystal. October will be our last month where we have Crystal in our base. After that, that will disappear, and therefore the comparison versus prior year will become a better or a fairer comparison. But right now, that's the way it is. All right. So that's the key points on the categories. I've got a few questions, so I'm just going to try and answer those that came in the mail. One of them was that in one of the call calls you had mentioned we have achieved 10% dispatches through full truckloads. I'm not sure when this was done, but it would be a while ago, I guess. So for the ready to eat snacks, right? We today ship about 90% of our ready to eat snacks are shipped through full truckloads, right? So only 10% of ready to eat snacks go through the depots, right? Because that's where there's a lot of incremental cost in terms of loading, unloading, additional freight, more warehouse space, etc., etc. We think this is a good number. Most commodity players will have almost 100%, right? But other companies which are in the branded space, like say Frito-Lay or ITC, will have mostly through depot. But we have this happy balance, I think, between the best of what the commodity players are doing and what the best of branded guys are doing. So that answers that question. And one question that we had from an investor was that, look, is your will your cyclicity improve, in the sense summer months? We'll give you the answer to that as time goes by. I don't want to give a straight answer, right? I can't give you, because, for example, ready-to-cook popcorn is lower in summer. People tend to eat fewer snacks, right? Similarly, chocolates has, environment. Heat increases in summer months, so it's more difficult. Volumes always, come down in the summer months. So the chocolate people, mostly their peak season starts around Rakhi and then goes through till February. So you're talking about September, October, November, December, about 6 months. And you'll see, if you analyze the advertising spends by month, which is there in our presentation, you will know what the peak months are. Okay? So let's see how our portfolio develops. Ready to eat probably doesn't have that much cyclicity. All right. And we also had a question on palm oil. So, has gone up in the last few days. Look, there's a lot of volatility in the market, right? And it all depends on, what is happening in Ukraine, et cetera, et cetera. But overall, I would say from our edible oils perspective, we have, and it's visible, we've seen a softness in the palm oil prices, and in some of the other oils as well. And I would say we are, like we were in the last quarter, we told you we are positive as far as this our expectation of what will happen in quarter 3 and quarter 4. All right. So coming then to page 13 in the comparative update, basically you can see here that Frito-Lay on snacks, on savory snacks, really dominated the spending, right? And the other highlight was DFM Foods, which is I guess in the process of being delisted now, has actually increased their spend significantly. So that is the other big change. Other than that, we don't really see too much change versus prior year. The next slide is number 14, which is spreads. Here, I think the key is, Kisan has continued to spend. So if you look at row number 2, which is Kisan PB, which is Kisan Peanut Butter, take the FY21 spend, that's 20 crores, FY22, that's 50 crores, 70 crores, 80 crores. They spent close to 90 crores so far, right? And you can make a judgment on how good or bad that is if you go into the market and see how the product is doing. We continue to spend in line with us. The other person who spent a lot of money this quarter is Biba. They tend to do this. They did this in FY21 also, putting front page ads in Times of India and Bombay, Delhi, etc., etc. They come and spend a lot of money, but then you can see they did it in FY21. Then FY22 they didn't spend any money. So let us see what happens now. And on the other, in the honey, you can see there is, I would say, reduced level of competitive intensity, right? You can see that, for example, Saffola honey not really investing any money this year. Even Patanjali is kind of, spend money in one quarter, but not in the next. And Dabur is fairly consistent, just like us. And in chocolate spread, you can see Hershey starting to spend money. And Nutella has actually started advertising chocolate spreads for the first time, which is great for us. And we'll be, hopefully able to leverage all this spending in terms of expanding our distribution, particularly for our entry-level packs, which will come in this quarter. So yeah, and our spends are broadly in line with prior year. Then breakfast cereals, really here the dominant spender is Kellogg, which has been the case from the time we have to give them full credit for building this category. And Nestle has actually discontinued support. So you can see here Nestle Cocoa Crunch. Last time the spend was FY21. So you still see the product, but it's I would read this as not an exit, but not therefore meriting support. And Saffola has continued to spend, as has Quaker, right? Tata Soulful has spent some amount of money in last year, 13 crores, 9 crores in quarter 1, but after that we see a little subdued. Let's see how this part goes, and we'll have to watch them as we go by. And Parle has spent some money. Parle tends to do this. They come in, spend money, and then they'll go away for a while, then come back again. All right. And chocolates really, Major Domo remains Mondelez, but all others also spending money. And as I told you, if you read the months, you can see that actually quarter 2 is a big quarter for them. So if you look at this from a seasonality perspective, you can see in quarter 1 the total chocolate category spending was 226 crores. In quarter 2, it has jumped to 563 crores. So that's a huge amount, right? Okay. And quarter 2 and quarter 3 really are the big quarters for the category. Edible oils, basically it's the mass oil share of spending. If you look at the premium share, which is Sunroof, Heart and Saffola, it's becoming smaller and smaller by the day, right? As a percentage of the total. So it's really the mass oil players now who have the dominant share of oil. So from a premium oils, category perspective, that is not good news, but that is to be expected. I think we've always told you that that's going to be the case. And as you know, we've not spent any money, and our focus will remain on protecting our margin in a sustainable basis. In terms of noodles, Nestle really dominating the spending with a lot of pricing. Other players seeking to leverage the price gap. So the price gap is becoming large now as Nestle has moved up to the 14 rupees price, and there's a lot more action there in terms of companies like ITC, YY Noodles, so on and so forth, all seeking to leverage this. Pasta, which is page 19, not much activity, so almost nobody's spending. I guess everybody's energy is going behind the noodles category. And page 20 is soups. Knorr really remains the dominant spenders. Excellent products that they have in their portfolio, and really at this stage leaving no room for anybody else. So we'll have to see how to crack this piece as we go along. So overall, I would say, 2:30, so 30 minutes, at about 124 crores of foods net sales. This quarter is really the closest that we ever come to annualized revenues of about 500 crores. So that's good. Margins have really improved from quarter one low. They still need to go up, right? We need to work on this, and work is underway to drive further improvement through operating leverage. Many of the categories are very small for us right now, right? Chocolates, breakfast cereals. So as we get scale in these, this will improve portfolio management, right? How do we manage the portfolio across categories and within each categories to manage pricing, so on and so forth, grammage, so on, and last is pricing as appropriate by category. I think the quarter two food revenue provides credibility and confidence. We said that we will be the best performing, most respected foods company in India, and the fact that we built up a business of about 500 crores means that it is not huge. It is not 2,000 crores today. It will be, but it shows that we are capable of getting to our ambition of one day being $1 billion business in India. And the great news is that the building blocks are very clear, right? So, for example, the building blocks for the next 500 crores is very visible to us. We have multiple levers of growth based on innovation across several categories. And the great news is none of it is third-party sourced. It's all in-house, right? So we are able to transfer capabilities from one category to the next. We are only going to get better as far as operating leverage is concerned, because in many cases our capacity utilization is low. So these building blocks are very, very clear for us, and that's a great proposition for us as we think and say, okay, how will our 1,000 crore business look like in the near term and subsequently even bigger? So with that, I think we close the presentation. I'd just like to make a few points, which is, yes, you can see the revenue growth and or the revenue decline figure if you look at it, and that's largely driven by mass staples, by Crystal, which is in the base. That in quarter three we'll have 1 month of Crystal in the base. After that it will disappear, right? Right, sure. Yeah. And employee benefits a little higher, but on a year-to-date basis still flat versus prior year. Depreciation not much change, and advertising and sales promotion expenses a little lower. We'd have liked this to be higher. Ideally, with a food growth of close to 15%, we should have 15% growth in A&P. That way, at least we are holding our A&P percentage. But it's been a challenging quarter. Quarter one was very, very challenging. Quarter two also. Obviously, the trajectory is great, but then you have to live with July the way it was and September the way it was. So right, and therefore, the profit before tax was 4 crores. Now, there's one other element here, which is under other comprehensive income. You see there's here that there is a charge of 3.5 crores and then also a charge of about 90 odd lakhs on account of tax on account of that. Basically, we just restructured the entire pay structure of the company, right? And so in the new pay structure, we are now 100% compliant with whatever we anticipate could be the possible changes in the labor code, at least as far as whatever we've seen from the draft labor code or whatever information has been given to the public, right? So that part is taken into account. However, as a consequence of that, there is a one-time charge in other comprehensive income, because gratuity, as you know, is a payout which is based on years of service and on the salary at the time when the person leaves the company, right? This is not today; it is sometime in the future, right? So on the basis of actuarial valuation, we have in consultation with our auditors, we have recorded a charge in other comprehensive income of about 3.5 crores. Yes, Shivu, have I summed it up correctly? Or, huh? Okay, good. All right. And other than that, let me see. There's not a lot more. Obviously, the travel and the secondary freight expenses that I talked about, you will see it will be visible to you in the other expenses. So So that's why, right? So going forward, we continue to seek aggressive increases in margin, and we will hopefully navigate through the year well. So Ajay, I think that's it from our side, and we're open to questions till 3 o'clock.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhruve Sangvi from Prospero Tree. Please go ahead.
Yeah, hi. Am I audible, sir?
Yeah, Dhruve, go ahead.
Yeah. So
Hi.
I have 3 questions, slightly qualitative ones. So today, as I see the company's journey, we have many products, more plants, more reach, more SKUs, and of course, more competition. And basically, things are getting very complex for us to evaluate who are not as savvy as a business manager. And when I ask myself that, okay, why am I invested in this company? The one big reason is Sachinji, you. The way you explain, the way you strategize, you are thinking very long term, having very big vision. And considering this, the only problem of evaluation comes when, promoters are completely different. And the bet for us in our mind is you. If you can talk a bit more on your thoughts, your incentives in the company, of course, on the qualitative side, how you think and where do you find some satisfaction, and your relationship with the promoters and how they think here. So that is number 1. That will give us a little bit more comfort as the company structure becomes more complex, because understanding market share gains a quarter, year and there is very difficult for us. That is 1. Second is considering the oil staple business, can we say that, when I see 230 crores revenue, 125 coming from food, so remaining is that oil staples business, can we say that this broadly 400 crore yearly revenue is what you think can be maintained considering, all the edible oil related noise, so many new people entering and getting commoditized, but can we hold that 400-500 crore revenue base and get 40-50 crore cash flow out of that business? Is that broader understanding correct? I'm not talking about quarterly, I'm talking about a couple of years, so that it gives us fuel for marketing and building up the food business much faster. And the last is, can we say that the chocolate business in the next 2 to 3 years, I'm only talking 2 to 3 years, can probably give us 200 crore revenue? Again, this is forward looking, but just a guesswork on your side that how aggressive is this number in terms of assumption, or no, more than 100 crores is very difficult over the 2-3 year period. Thank you.
Okay, thank you, sir. Thank you, Dhruv. So Dhruv, to your first question, yes, it's complex, and you wanted to know my thoughts. See, I'm a slave, right? We're all slaves at the end of the day, right? We're not slaves as in, slaves, you remember the movie, which is 20 years a slave or 12 years a slave, I don't know, right? But at the end of the day, we are paid to create shareholder value, right? For the promoter and for all independent shareholders. And that is why our approach to the business is extremely transparent, right? You can see that. Today, actually, you don't really need to possibly ask a lot of questions in the call also. It is good you're asking the questions, and we appreciate it, right? Because we need dialogue. We also learn from these calls, right? And we get feedback also, and which we have to take positively, right? But there's a lot of information which is available. You virtually have the entire P&L of the company, visible to you. You have every element of it by the time we post that investor highlights page. So I would say the focus of the management team, which is all of us, in the company, and even all the management in the company, is at the end of the day to create a great company, right? People are not, we think that people are motivated by money and greed. That is not really the answer, right? People are motivated to do something great with their life, right? And not everybody is like that, but over time you create a team which is all motivated towards building something, right? So that is how we happened. That is how we've gone from 10-15 crores of food to 500 crores. That is how we'll go from 500 to 1,000. That is why we'll go from 100 to 1,000 to 2,000, right? And that is why we're, not just me, the entire team is thinking right now, what are we going to do? Because to think about 1,000, what are we going to do at 1,000 crores? You really need to start thinking today. You see, because a lot of saplings have to be planted right now. They may appear very small, but by the time we get to 1,000 crores, then we should not be looking for new growth opportunities. All right. Otherwise, we'll be forced to make acquisitions, and acquisitions, as we know, are not necessarily cumulatively if you look at the cumulative record, acquisitions are not only the best return as far as the shareholder is concerned, right? Especially for a growing market like India. And we're talking large sums of money. So, for example, if you take a look, Tata Consumer just incorporated that smart food business of theirs, which is coming out of Sri City, right? Total assets incorporated were 395 crores. If you go into MCA filings for last year, the turnover of that company was 11 crores. Right? Or Soul Food got sold, right? For, I think, 38 crore business sold for 150 crores. So, and these are probably the right choices for those companies, I'm sure, because they're all smart people running the company. But we don't want to be at that stage when we are that size, right? We want to be able to leverage the work that we do today. So those saplings of today are all 20, 30 crores at that point in time, and with in-house production, so that all of those can be leveraged. Because otherwise, we will reach that point and then we'll say, no, it's going to come from. And then we might, we don't want to do silly things like overspend on advertising and other things. So our vision has to be long. Our vision has to be very long, and there's a huge potential for growth, right? Let's face it, there aren't too many companies today at the top of the pyramid. And honestly, we must be one of the very few 500 crore companies which has the portfolio that we have. But these are not built for today. These are built for 5, 10, 15 years from now. Okay. The other part is oils. I think, look, revenue is very difficult to call on oils. One of the reasons we've exited mass staples is that there's a revenue swing, right? I'll give an example. When we sold Rusk to Cargill many years ago, and today, the price at which Rusk is being sold is 3 times, right? So, but it could come down tomorrow also, right? So that's the same thing with edible oil, right? So revenue is very difficult. From our perspective, what we focus is, can we get a steady gross margin? So we've called out in our presentation 70 crores plus minus. It could be 65, it could be 70. It all depends, right? So we need a right gross margin, and we need to ensure that it's sustainable. It's not that it will come one year and it will not come the next. That is why we took the price reduction 2 years ago. When we took the advantage of lower travel costs, we put it behind oil's pricing, right? Because we said we want it to be sustainable within a range, obviously, right? But it will always, the focus will be on margin group, not so much revenue, right? Because the revenue exposure we want to get out of. All right? And the last is chocolate. Yes, I think it's going to be a big business. It's visible. If we are thinking of setting up a capacity of about 100 crores plus next year, we are certainly thinking of 250, 300 crore business coming in the next 2 years, right? Exactly how much, who can tell? I can't tell you that answer. But what we do know is a 15,000 crore food business, category. What we do know factually is that we have a great product. You don't need to know it from me. Go into the market and see where our stores are selling and ask the retailer, how is Agrotech Sundrop Duo? They'll tell you it's moving like a rock star, yeah, right? So we just have to figure out the business model for that. But there is enough scope in this category because it is. So let me give you an example. Historically, you would not have seen many gondola ends being taken by us, right? But because gondola ends are those shelves that you take at the end of the gondola and sometimes close to the checkout as well. So because the revenue from, if you put a gondola and a popcorn, the revenue will not pay for the cost of the gondola end. But in a category like chocolates, it does, right? You spend 5,000 rupees in the end, you can get 30, 35, 40,000 rupees of revenue. So yes, these are great categories. They are very impulse-based. They play to distribution strength. We have a great sales organization, which is, the backbone of the company along with manufacturing. And yes, the answer is it's going to be a nice business, and that's why we are investing in it. Okay? Thank you, both, for the questions. They were all thank you. Thank you, sir. Next question, Ajay.
Thank you. The next question is from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Yeah, hi, good afternoon, sir, and thanks for the opportunity. My heartiest congratulations for doing the good efforts to deliver a very strong growth. Three questions. You have not mentioned anything about the international, and this is what for quite some time we were talking. So maybe if you can give some clarity. Second question is that on the investment of 100 crore, what we have spoken about chocolates, how are we going to fund? And third question is on the entry into the high protein variant peak. The question here is that how big is this market? What are the growth rates? And maybe some quantitative backup if you can share with us.
Okay, thank you, Shirish. Thank you, Banu. Thank you for all the questions. So, Shirish, on the first part on international, international for us is basically Sri Lanka, Bangladesh, right? Sri Lanka is, you would know as much as I do. I haven't been to Colombo for a while, but it is dealing with its own share of problems. I'm sure the country will come back. So right now there's not much transaction happening on Sri Lanka, right? We have an entity there, and we continue to retain it. We'll watch the circumstances, right? So that it's and as it recovers, which one day it will, all countries do. They go through their own turmoil, and we will be there. The thing is to be there at the point. Obviously, if there is some good acquisition opportunity, we will evaluate it. But as of this point in time, it is just a hands off. Okay. In terms of Bangladesh, Bangladesh is also having challenges, but the business is doing fine. And Bangladesh, look, our focus is clearly India, right? Because India is going to be where the biggest size of prize is. But one should always be in these markets so that we know what is going on, right? We seed plants. We have a plant in Bangladesh. It is also a sourcing play for us, right? Even today we source some popcorn from Bangladesh, right? We import, we pack, and we bring into the country, and it is also therefore a supply chain alternative for us, and that's important. That's important for us from a strategic perspective, right? So Bangladesh has a strategic role both in terms of supply chain perspective and in terms of being a large market with good potential, right? Sri Lanka has an importance in terms of being a good neighbor and therefore a part of it. However, it is a much smaller market and is going through turmoil. So at this point in time, we are not really engaging with too much energy or even investment in the market. As and when things turn, we'll change it. I apologize maybe I was not clear on the chocolate slide. So I just want to clarify that when we have said 100 plus crore capacity, it means capacity for 100 crore of revenues. Okay, so that was why Dhruv asked a question about 250 crores. We are looking at building a capacity next year only, which can generate about 100 plus crores of revenue. Okay, and yes, the answer to that is how is it being funded? That is being funded through our cash flows. I mean, it is funded right now through all internal accrual. As you know, our entire gross block over the last 15 years has been funded entirely through internal accruals, right? We've got a gross block of whatever 344 crores, correct? Shinu, how much? Correct? Right thereabouts. And all that is due to the money that we earned from the company. We took some risks, we took some gambles as far as the oil business is concerned. But today we've built up a nice food business, right, which is clocking at close to 30 crores of gross margin a quarter. So I hope that clarified that part of the question. In terms of the high protein variant, I don't have a lot of data for you, because the trouble is even the data that you get, let's say from private equity, right, is very inflated because they don't mark down the discounts and etc. So the gross merchandise values that are often quoted are not at all comparable with net sales of our companies because they might have a 30 or a 40% trade discount. So it's which is good from a valuation perspective, but doesn't provide a good picture as far as for us to concern. What I can tell you is that protein is very, very important. It is important in peanut butter. It is going to be important because of plant meats. It will be important in bars. So if you do a Google search, you'll see Mondelez just bought the Cliff bar, right? Cliff is one of the major players in the US, right, in this area in protein bars. And Mondelez, I think, paid close to $1 billion for it, right? So I'm sure they're going to introduce Cliff in India as well, right? So their Cliff will be our competitor to Peak. Okay, and they both kind of are in the sort of similar space. And it will be important. How big it is, I'm afraid I don't have the data, but we'll try and get that for you at some point. Okay? Thank you.
Thank you, Sachin.
Thank you. The next question is from the line of Chirag from Keynote Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. First of all, congratulations, Sachin sir, that we have reached the target of 500 crores in food businesses. I have 4 questions at this moment. First is related to gross margin. We see that on YOY basis that we have improved our gross margin from 72 from COGS of 72% to 68%. But if I see on a quarterly basis, we are still in the range of 68%. Even if our food businesses as a percent of total sales have moved from 44% to 54%, and it has started giving a higher contribution. Plus, our mass oil business has reduced drastically. Still, I am not able to understand that why are our gross margins not able to improve. My first question is that it would be very helpful if you can give us financial highlights of how the gross margin is panning out in both the verticals like food and oil. It would be really helpful to understand and pick the numbers in better way. My second question is related to the distribution chain. I see that we have reached the mark of 1 lakh in multiple verticals of our food business itself. But I just wanted to understand that what kind of difficulties are we facing to increase our distribution reach, like reaching from 1 lakh to 2 lakh, if that is our goal that we have to pan out within an entire India. So it would be very helpful to understand that how are we panning out and what are the difficulties are we facing to increase it on a year-on-year basis. My third question is, like, I just wanted to understand related to the competition perspective. It is great to see that we are firing all the cylinders in food business and every business is growing well. But just trying to understand that on ground, we are also starting to see more of competition in place. May it be organized, may it be unorganized market. So what is our competitive edge within our food categories, which is helping us to stand out in our competition? And my last question is related to understanding like how ad spends would move. Like as we are increasing our product portfolio and we are focusing more on multiple verticals, may it be RT, may it be chocolate, and it would require some promotional activities, right? So as a percentage of gross profit, which we actually look at, it has been really stagnant, like 8% of gross profit we spent it on ads and promotion. So should we expect that going forward, it is going to increase as we are panning out into new product lines? Thank you.
Okay, thank you. So, Chirag, I guess that will be probably the last question for the day, right? All right. All very good questions. Thank you for asking them. So we don't look at it the way you do in terms of, obviously you're taking it from the ad in terms of net sales less cost of goods. But let me try and tell you from the way we look at it, okay, in terms of gross margin. See, our food gross margin used to be in the range of about 26 to 27%, something like that, right, before COVID, right? And then when COVID happened and, we had a disproportionate increase in our ready-to-cook business, right? You can go back to those numbers year before last. It actually, crossed well ahead of 30. It went into the 32, 33% range, right? And then, of course, COVID put it down, and then there was this huge commodity onslaught, right? And you can do the maths in our investor highlights. You can see if you divide the gross margin that we mentioned in the bottom of the financial highlights, where we call it performance highlights, you divide that 28.7 by 124, and you'll get to a margin of about 23%. In quarter one, I think it had dropped down to under 20%, right? Because this whole commodity onslaught was there, and we had to navigate through it so that the important thing is that we are building this business quarter on quarter so that we navigated through, and we had to convince our parent company also about it. And we navigated through so that we exit the year well, and then, we continue, our journey continues. That CAGR of 19% continues. Obviously, in 1 year it can be a little more, in another it can be a little less, but it must continue. So I think right now what has happened is from the 25 to 26, 27%, we came down to sub 20% in quarter one. We've already recovered to 23. And as I said earlier, you can do the maths, you're all smart. If you look at the trajectory, if quarter one was an average of 20 and quarter two was an average of 23, clearly the graph is upward. right? So our first task is therefore to just get back to that 26, 27, and then work out with operating leverage, with the right mix. Ready to cook will also start going. How do we get to that 30% gate that we always called out as our minimum expectation? Okay. Less than that, we don't believe you can have a business, because it's not going to be a profitable double-digit EBITDA business. All right. In terms of distribution chain difficulties, there are tons of difficulties. Okay, I mean every day is a difficulty, right? And it's only going to become more challenging. But that's great, because you know what? It's a mode that is only going to become more valuable. Today there are, as you said, a lot of competitors. Because there's so much private equity money which has come in, right? But most of them are in the internet space. The moment they start coming in, that private equity money has to fund distribution expansion, particularly in the traditional trade. That's where they reach a block, right? Now, the good news and the bad news is that the only thing that you need is you need to be willing to slog. Okay, you get distribution in India by slogging. You get to work at 9 in the morning, you work, you make your calls, 35, 40, 45 calls, report back to the distributor points, make sure the deliveries happen the next day if it's an order booking, and you slog, and you slog, and you slog. And you keep doing that, right? 1 year doesn't make a difference. You do it 5 years, 10 years, 15 years. That's the mode that Hindustan Lever has. Right? Now, it's a different issue that because of their size, they are not able to handle something like peanut butter, right? But that's the mode that they've created, right? And that's the mode that we have today, right? How do you get distribution? You get it by slogging. I can remember a time, I was in Chennai 2 weeks ago, and I can remember a time in Chennai where we used to go and we used to get an order for one line. One line means one SKU from that retail store. The least number of lines orders that I got in any store in Chennai, in a small store, was 11 lines. There were small stores ordering 11 lines on us, stores ordering 16 lines, right? Okay, stores ordering 50 lines, right? That is the power of the portfolio. You see, the critical thing for distribution is you have to think about the distributor. One of the reasons why we have this portfolio today is, of course, these categories are attractive and they're all growing. But the other reason is, for our distributor, he is now targeting 5 categories in his geography. If we were just selling instant popcorn, he'd be targeting one category or one part of one category. So his ability to get revenue or her ability to get revenue from a small area is much better when we are competing in number of categories, right? So the answer is only slogging. You've got to keep doing it. We've obviously invested resources as well, but right now we are not adding more people, right? Because our expectation is within our 4.5 lakh stores that we've got coverage, we still have a long runway for growth. Breakfast cereals we can take up to ITC levels, right? To popcorn levels. That's 280,000 stores. So I think a point will come in the next few years. Our expectation, Vikesh, our salesman, director, and our expectation is that chocolates will cross popcorn, right? Because the size of price is so large, the category size is so large. So this is you need to be willing to work hard, and you have to have the portfolio, right? If you don't have both of these, there's nothing you can do. So if you say, Sachin, we're going to work really hard and we'll drive distribution, but if you don't have the portfolio, you don't do it, right? I was talking to somebody, who set up a tortilla chips plant in Kashipur, and he said, sir, product mera bahut acha hai, but he said, mere paas portfolio nahi hai distribution badhane ki. Because that fixed cost of the sales organization is huge. And that is where it comes to the third point that you raised, which is competition. Competition is there. And they are obviously, it is useful. The current play of the internet and, giving some additional margin to the modern trade is useful. But it takes you only up to a point. To actually win in India with 1 billion people, you need widespread distribution, right? The rest you will come, you will create some business, you will sell it out to somebody else, etc., but it's very hard, okay? So this distribution mode that we've now built of 500,000 stores is great. And I think if we had to build that distribution mode today, it would be very, very expensive. It would be extremely expensive and frankly, I think almost impossible to do, because I don't know many other companies who even are showing signs that they will be able to do it. Okay? So that's one. And obviously the other part is differentiated products, right? So either you have differentiated products through which you can, gain share. So for example, we have our coconut dough is a very differentiated product. Now you can say, oh, but by the way, Sachin, I think Bounty is a better product. And maybe that, that could be a valid personal view. But the fact is that Bounty is not relevant in India, right? We are available in close to 1 lakh stores. Bounty is available, I don't know in how many stores, maybe 5,000, 10,000 stores, and very expensive. Similarly, our Peanut Duo is a great product. It's great value, right? And for the consumer. I was in Chennai the other day and, as I said, I asked, it was a small self-service store. And I think it was the 20th of the month. And so we asked them, we said, we go and find out in the last 20 days what is our sale and what is Snickers sale. Snickers has, as you know, spent a lot of money on the category. The Snickers sale was 31 pieces in that store, ours was 36, without spending a single dollar on advertising. Right? So that's the power of great products, great packaging, and a great sales force. Right? We have a great sales force. Okay, so the different products. Where the products are not so differentiated, then you necessarily have to be price competitive. You have to bring value, right? And that's why it's important. I had a pyramid, and maybe I'll touch on this in the November analyst meet, right? Which I hope will be in person. You need the full portfolio. You need those value products at the bottom, which sell for 250 to 300 rupees a kilo, and then you need those products at the top, which is 700, 800, 1,000 rupees a kilo. But you can't do without either of them. You need all of them. But if you have all of them, you will have control of your category. Okay? And last is ad spends. 100%, I would say, our ad spends today are less than desirable, but there is a reason for it, right? We are at this cusp where we are reducing the dependence of the edible oil business, right? And, we are transforming. It's visible to you. It's probably more visible to you than it is to me, because for you can see it from a distance, like, when you see a child who's growing up after a year or two. For us, we are knee deep in it, but it's transforming, right? Oils is becoming a smaller share of the business, and this is part of the pain of that, but that's okay. Every transformation has its pain. Nothing comes for free. But as I think we all believe, it's a great food business that we have today. Annualized run rate of 500 crores, 5 categories. We don't need to think of where the growth is going to come from. There's no debate, right? At this point, the only debate is, okay, what will be the cost of that growth? That's all, right? That's a nice position to be in, right? So it's like we don't really nowadays make strat plans like we used to, because it's a volatile world. But I don't think it can get better than that. All right. So thank you, Chirag, for that question. And Ajay, I guess, thank you very much. And Stephen, over to you. We'll close the call now. I apologize to those who have unanswered questions. And, we'll look forward to the next call. Cheers.
Sure, sir. So any closing comments before we disconnect?
No. Thank you all for taking your valuable time out. We really appreciate it. Cheers. Thank you.
Thank you. Ladies and gentlemen, on behalf of Anand Rathi Share and Stock Brokers, that concludes this conference. We thank you all for joining us, and you may now